Hi, my name is Z, and I'm an options trader, and I've been growing my portfolio by 25 to 50% every year using options. Today, we're going to talk about how to trade vertical spreads, the pros and cons, and a checklist for deciding if you should be using a vertical spread as opposed to just buying stock or buying one long option. Let's begin. So a vertical spread is a spread where you buy a closer to the money call or put and sell an more out of the money call or put. So in this particular example, this is a call vertical spread where you buy a $50 strike call and you sell a $55 strike call. You pay $2 to get into this trade, so your max profit is $200 if the stock is a 55 or above at expiration, or $200 max loss if the stock never makes it to $50. So the long strike is at $50. The short strike is at $55. Implied volatility is basically the market's expectation for how much the stock is to move given the pricing of the option. So a higher implied volatility means that the market is expecting the stock to move more in order for that option to pay out, as opposed to a lower implied volatility. It is basically a gauge of how expensive an option is. Skew is how the pricing changes as you go up and down the options chain. So sometimes the implied volatility will go up as you go up the options chain, and sometimes it will go down as you go up or down the options chain. And this is very important in determining the pricing of spreads, and we'll take a look at how that works on platform. And lastly is delta. The delta of a single option is basically a representation of how many shares that option is priced at instantaneously. So if you bought a 50 delta call, that call is behaving like you bought 50 shares of the underlying. And vertical spreads are basically a way to get directional exposure on your own terms. And what I mean by on my own terms is you can kind of design a underlying to have any sizing or volatility skew or time decay as you want. So let's take a look. So say I wanted to trade SPX and I have a relatively small account, maybe like $10,000 or less. This is a $5,600 product. If you were to be trading, single lots on anything that is not 0 DTE, you're going to be looking at buying options that are thousands of dollars. This is, $1,000, and most of the options on here are going to be, many thousands of dollars. So vertical spreads allow you to get exposure, or you trade this underlying with any amount of risk, any delta that you want. So for example, say if I wanted to get, a 10 delta, I am bullish and I want to be bullish about 10 deltas of SPX. 10 deltas is equivalent to 100 shares of SPY, which is a lot of SPY. That's over $56,000 of SPY. Well, we can simply do this by, say we want something that is 5 days to expiration. We can get something that's 10.1 delta. So that's only $380 to express what is basically the equivalent of, instantaneously equivalent of $56,000 of SPY. So this is pretty amazing, and this is, and I can design my risk reward also. So right now I'm paying 3.8, which is $380 to get into this trade. The max gain on this trade is $1,500. So I'm getting almost a 4-to-1 my risk reward on this particular trade if I'm right. So if I wanted to get something that is, say, a little bit closer to money, but still have a 1-to-1 risk reward. See, this is a $10 spread for almost $5. This is about a 1-to-1 risk reward. So as you can see, you can turn an underlying of any size and express as much directional bias as you want, and be able to kind of turn this underlying into as small or as big position size as you want. A lot of people ask, like, what is the way you can kind of, if you are trading SPX, right, and say I wanted to put stops on SPX and understand the pricing of spreads, what you can do is this. So say your stop for SPX is, let's just, for the sake of simplicity, 100 points down, because you're kind of playing against this candle. You think it's going to go up and you want to get stopped out somewhere around here. Right. Well, if you have, say, I'm going to give myself a little bit of space. I'm going to give myself almost a month to expiration, and I'm going to put on a bullish trade. Say I want something that is 2-to-1 risk reward. So I think I might be able to get 2-to-1 risk rewards somewhere out here, maybe like a little farther out. Maybe one more strike out. Okay, here we go. So this is a bullish vertical where you can make $10 and you pay $3.75 to get into the trade. So if we wanted to know what the pricing would be if, say, SPX moved up to its all-time high, which is only about 40 handles from here. So the way you would do this is by, say this is where the spread that you purchased is, you can just move it down by 40 handles. So that's 85 and 85, and you unlock. And now you see that if the market moved up by 40 handles, you will make about $110 on the trade on a risk of 380, which is not bad. And same thing, say if you wanted to get stopped out of the trade about 100 handles down, then you take the spread that you have and you can just go up the options chain by 100 points. 35. And this is, if you were to get stopped out instantaneously, this is how much you would lose, which you would be losing almost $200 on the trade. This would be a lot less devastating than if you were to just buy some call that is $5,000. If this goes down by 100 handles, you'll be losing a lot more money than $200. You'll be losing almost $300. So you can see that there is kind of an asymmetric risk reward that you can get with vertical spreads. And I know people that basically exclusively trade vertical spreads. They're risk defined because you can only lose how much money you put in, and you can kind of design the option to have any risk reward that you want. So it's quite a powerful structure. Now the benefit is, like I mentioned, you can adjust your risk reward. Number two, you can get really favorable pricing with vertical spreads. So for example, the pricing of a vertical spread has a lot to do with the implied volatility skew that you are buying and selling. So for example, on the call side, in general, as you go up the call chain, the implied volatility actually goes down as a product of supply and demand. There are a lot of people selling calls out here because they have extremely long portfolios that they want to just, take risk off of. But more on that in a bit. So here you see that at around $65 out of the money, a $10 call vertical spread is at $4.45. Now you see that the skew is not really in our favor because we're buying something that is 11.2 vol and you're selling it at 11.12 vol. You can see a difference if you do the same thing, except you go down 65 handles. So you go down to 65 handles, you'd probably be somewhere around here and do $10. You'll see that the pricing is very different. And this is due to a couple of things, the delta being different, but a lot of it has to do with the fact that the implied volatility skew is in our favor on the downside. Because you're buying something that is you're buying something that is 14.25 vol and you're selling something that is theoretically more expensive than you're buying. So this kind of comes into effect when you're kind of going after high beta stocks like tech stocks. So let's look at Nvidia. You'll see that Nvidia, the call volatility skew is actually in our favor. So, call spreads, a $2 call spread costing only 55 cents. You would think that would not be the case given, how it's much closer to the money than the SPX. You have much higher deltas, and yet this thing is cheaper. Theoretically, it's only 1/4 the width of the strike, whereas the one we priced out is almost half the width of the difference between the strikes. So this is mostly because of the call. The skew really plays a big difference in how the pricing goes. So if I were to get bullish on Nvidia, I would be more likely to use kind of call spreads. Whereas if I were to get bullish on something like SPX or something that has worse skew, I'd be more inclined to actually just buy single options or even buy the stock outright on margin. Because when you're selling, anytime you're selling something that is of lesser implied volatility, you're just kind of buying high and selling low automatically, which is, really screws up your risk reward. So this is favorable pricing with skew is an extremely important part of, placing your call verticals correctly. Slower time decay, because you have a short option in there, it kind of offsets most, if not all, of the theta, especially if you're doing something that is at least a couple weeks out of a couple weeks in the future. Your defined risk, you have no unlimited risk like selling puts or selling calls, and you're really resistant to changes in implied volatility. So, as an example, in the last kind of market downturn, even if you caught the bottom right here on that day, and say if you were buying calls in something like Nvidia on kind of your bottom fishing on this day, if you did not know how to use verticals, even though the market kind of rocketed up in the next 2 weeks, depending on how far you bought out of the money and what duration you have, you can still not make any money. And that's because the volatility has crushed so much on the way up. And generally buying call verticals is very good when you are trying to buy the dip, because you know that there will be a volatility crush on both the long and the short strike, so it kind of offsets each other and makes it so that you can get directional exposure without volatility exposure. Now, the drawbacks of a vertical spreads is that it's just not as exciting as having a single option where you can have theoretically unlimited upside. I mean, we just showed something where you can construct something on SPX that can have 4-to-1 risk reward. But the theory is, you can have an infinite risk reward, right? When you're buying single options. So, capped upside and lower profit if you're right immediately. You have to be really careful how far out you buy the vertical spread. People think that the longer, there's kind of two schools of thought. You can buy something that's cheaper and it's closer in time and it's cheaper, but you kind of offset the value of having that short strike, and you're going to be more acceptable to theta burn. And a lot of people would put their expirations really far out, and the problem with that is that if you're right, so for example, if you're going bullish and you bought a $10 wide call spread, if you're right immediately, and say even if this thing moved like $50 in your favor, you're just not going to make that much money. You would have made $100 if you were if the SBS moved up $50 on a $10 wide spread, and that is just extremely disappointing. And this is especially so when you have a news event in between now and expiration. What will generally happen is that the volatility will not go down on your short strike, and And this is especially pronounced during earnings. So for example, Nvidia has earnings next week. You see that it still has an expected move of $50. If you look at a week ago, let's do a week ago here, and this is the earnings date, it's still $15. So the volatility has not come down at all on the short strike, and you would have had to have a really, really big move for your vertical spreads to have paid out anything if you bought a vertical spread after earnings. So I generally don't like buying vertical spreads against earnings. I like to keep my short in front of any announcement, and if I were to be long anything, I want it to be after the announcement so that it retains its value really well, and I get the off chance that if I was wrong, but the earnings or the announcement, kind of can bail me out and have an outsized move in my direction. So, how you can really make not very much money if you're right immediately on a vertical spread, and then depending on the volatility and how far out the contracts are. And lastly, you get no benefit from gamma or volatility. So a lot of the reasons why people play 0 DTE single options is that not only when you're right, not only do you get the directional, the delta change, but the delta actually ramps up extremely quickly on you because you're going more and more in the money, and you get this burst of supply demand for the option, which juices it up even more. Whereas if you buy a vertical, any benefit of both of those are kind of offset by the short strike, so you don't really get that that extra juice that you would want when you're trying to scalp. So you usually don't use vertical spreads for scalping. I think you do vertical spreads more for like positional play, maybe something that is 2 weeks to 4 weeks out, in a high volatility environment, against you. If there is some, if there's some resistance level that you think that you can play against, that you can get some good premium and make your long call or put a little bit cheaper, that is a good time to use a vertical spread. So let's go through the checklist. Question number 1, is the cost of stock and options too expensive for your account size and or what you're trying to express? If the answer is yes, then do options have relatively high implied volatility? This one is not as much of a requirement, but the next one really is skew in your favor. Are you buying an option that is cheaper and selling an option that is more expensive? Are you buying low and selling high? And lastly, is there significant downside risk that is hard to manage? That's the downside of buying stock, is that if you're buying an instrument that is very gappy, like Nvidia, there could be some war news, some China news, God knows what, and you can't kind of dynamically hedge it in the middle of the night because you don't want to wake up at 1 o'clock in the morning to be selling in the pre-market to delta hedge your position. You can just get something out of this defined risk and sleep well at night knowing the max you can lose is how much you paid. So I hope this content was valuable to you. If it was, please like and subscribe. I will be putting out more content like this. I will put out another video on tips and tricks on how to manage your vertical spreads. Entry is, I would say, 50% of how to be successful at vertical spreads. There are many ways you can manage a vertical spread and get your money back even if you're wrong. And I highly recommend you check out that video. Okay, thanks. Bye.